Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Now before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these My Daily charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. There had been here one dominant pattern that 19 weeks ago took a break on the downside. It's of course the late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it, but the main pattern can still be clearly seen on my daily chart. 20 weeks ago I laid out targets below for this pattern, and I quote, "A primary target X would be in the 226 zone. The secondary, harder to reach target X1 down in the 194 zone." End of quote. 18 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during around the 50% absolute Fibonacci line at 219. Now please remember that level as it will crop up again later. The reactionary rise we saw back in March only managed to move up towards the mauve medium moving average overhead, which is currently at 215.5. Not even managing to test it, but rejecting further upside pressure. This mauve medium moving average will also show up again, but please also remember it. We then dropped lower after that, more or less, down to lows that had not been seen since March last year. In the meantime, I also added a target for the bearish halfway hesitation we made back then, down in the 206 zone, which I later finessed to the 208 zone. 8 weeks ago prices reached the target at 208, and 4 weeks ago they reached the further target down at 205. This just left the tertiary and much harder to reach target X3 down at 194 still open. I'm usually loath to downgrade or retire patterns or targets. I suppose this is due to my conservative nature, but 4 weeks ago I retired the ultimate and far harder to reach target down at 194. This was after I saw prices recover back up for a second time towards the previously mentioned 50% absolute Fibonacci line at 218.75, and more importantly up to the also previously mentioned declining mauve medium moving average. The market has since pulled back down again, down below the congestion at 208 and down to the newly redrawn since May bright red uptrend, currently 204, where we seem for now to have stabilised, or at least started to stabilise. In the process, we have filled in the big old changeover gap seen in mid-May between 205.5 to 211.25. But on the way down, we left a smaller, higher up gap between 214.25 to 214.75, which is still open. All this has allowed me last week to draw a new purple highlighted mid-March, mid-May bearish shift pitchfork, which seems apt at fitting in with the market's actions. Right now we're in between the middle time below, currently at 206.5, and the upper time above, currently at 218 even. Now, last week I said something which I'd like to repeat, as I think it was an interesting observation, and I quote, "I'd watch this bearish shift pitchfork, especially the middle time, as we seem to be running out of time." You see, what I mean is that the middle time crosses down through the bright red uptrend in about 4 weeks. So it's now about 3 weeks away. And I continued. At the end of July, and I suspect before then something will have to give. Add to this the pressure above from this mauve medium moving average and the static 50% absolute Fibonacci line, and it may be that we see a test down towards the July 2021 low at 197.25. Watch this space. And that's the end of the quote. Minneapolis wheat. The sideways triangle over February to May had run this market lower in mid-May, but then we saw the impact of the slightly realigned September 2019 to date uptrend, currently at 574.75, as well as the congestion below at 578.75, and prices turned higher with the added impetus of a changeover gap higher. Then resting for a bit, just over the medium and long moving averages, currently 616 and 3/4 and 617 and a half respectively, and creating a small bullish halfway hesitation that 5 weeks ago reached its target on the top side. In the process, the market pushed up over the April 2024 low at 635 and eyed the overhead August 2018 high at 650, and further congestion at 652, but becoming capped by the lesser Fibonacci line at 644. That was until mid-June, when prices made a splendid bullish opening long white Mariposa, peaking over the earlier 2025 high at 659.5, though not by much. However, further up, we have more congestion from the November 2017 high at 667, the 50% Fibonacci line of the May to August 24 move at 669, and the May 2021 low at 676, and most importantly, from the July 23 to May 24 dark blue downtrend extension, currently at 653.25. That capped prices 3 weeks ago and again last week. Interestingly, the drop in between those two peaks was only as far as the combined congestion of the short medium moving average, currently at 620 and 3/4. The medium moving average currently at 616 and 3/4, and the long moving average at 617.5. Now these three made up a pair of golden crosses 2 weeks ago, and arguably a possible bow tie formation of all three of the moving averages. However, this is a scrappy bow tie formation, with the medium moving average and the golden moving average still not crossing over properly, even now, though they came awfully close. I'll keep an eye on that one. Anyway, the recovery last week ended in an indecisive spinning top pattern last Friday, capped by the dark blue downtrend. Not the most encouraging sign for any of the bulls out there. So where does that leave us? Well, we still seem to have good and slowly rising support below from three major moving averages, plus the final feature is one I spoke about 3 weeks ago, and is still there just about. It is to look again at the action over June as a possible bullish halfway hesitation. In this, we have a question as to whether to measure it from. Should it be from the dip in late May at the 608 level, giving us potential up to where we've already reached, or should it be from the May low, in which case we have potential up as far as maybe 685 area, which is well over the previously mentioned resistances. This continues to be the question for the weeks ahead. Will the market have the incentive to try that far higher or not? London UK feed wheat. There has been on this daily chart for about a year one major significant pattern here, a pattern that we have not seen in the other grain markets, is the bright red late May to early July 2024 bearish shift pitchfork. The market in late February this year reasserted the then dominance of this pattern, with prices breaching, then repairing an attempted break higher over the bright red upper time. It's currently 170.10. Add to this the earlier this year narrow mix overhead of all the moving averages, though they are now separated out, as well as the 50% absolute Fibonacci line at 180.5, and you had, I suppose even now, still have an area overhead that, as I've repeatedly said for months and months, have been brewing up for a significant move, which happened, or should I say started to happen, over late February and into March. With changeover last week, I've seen a huge gapping move higher that's punched up and out of this bright red bearish shift pitchfork, as well as over all the moving averages, leaving only the 50% absolute Fibonacci line above still valid at 180.5, though this is now looking very, very vulnerable. However, this action has allowed me to discuss two new patterns that have developed as a result of the moves higher. The first is the action with the changeover gap, and how it has created the opportunity not only for a possible monthly key reversal, but a possible immediate countering monthly key reversal up, if only just. Thus, if on Thursday, the 31st of July, we close either above 157.20 or under 136.60, then we're beyond. Anything in between will have a lesser outside month pattern. Right now, well, we are most definitely looking at an immediate countering monthly key reversal up. The second pattern is the purple above the market July 23 to date downtrend, currently at 183.85. I had not previously highlighted this downtrend as I didn't think it needed it, but now it is coming into play, and interestingly, it is seemingly moving in to help reinforce the 50% absolute Fibonacci line. More on both of these two as the market develops. This all leads me to my final 4 points, and the same 4 points I've been discussing for weeks now. And 3 of them were something that I noted back in my annual commentary back in January on London Feed Week. Firstly, I saw back then the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern, akin to a double top, but formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, August to date, very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in dark blue on my daily chart. It's currently at 167.95. For most of March, prices slid along the top of the support from these pair of necklines. However, 10 weeks ago, prices dipped down again below the neckline, setting up the opportunity for a recent bearish half hesitation for potential target X in the 151 even zone, and at the same time making the lowest lows and low closes since March last year. 3 weeks ago, when I started to suspect that time might be running out for this pattern, the market produced a strong and dramatic move lower, easily reaching target X and bypassing the April and May 2020 lows at 149.95 and 148.45 respectively, dipping below the March 2020, indeed the 2020 low at 145.43. By doing this, the market has spiked lower into a large congestion zone seen back in between 2016 to 2018, between 136 even to 147 3/4. This strong move lower also created a weekly key reversal down seen 3 weeks ago and set up a monthly key reversal down for June as a whole. This dramatic monthly key reversal down for June, coming as it did after the monthly key reversal down we saw in April, applied a huge amount of longer-term bearish pressure to the market, which we saw exhibited 2 weeks ago with prices dropping down to the important 61.8% absolute Fibonacci line at 137.90 and the longer-term March 2016 to date bright green uptrend, currently 136.60, and most importantly, just ahead of the bright red lower time, currently at 134.5 with the same old bright red late May, early July 24 bearish shift pitch wall, from which we saw a small recovery. As I said 3 weeks ago, and I quote, "I'm prepared to soon give an idea of potentials and actual targets below for a break lower. I just want to be certain, which is why I think the bright red bearish shift pitch wall and the congestion zone between 147 3/4 to 136 even, dating from 2016 to 2018, are so important." End of quote. Well, we had a second consecutive monthly close below the combined dark blue neckline above, so here goes. For this, I think it's best if I switch over to my longer term monthly charts so that you can see a better view. Thus, a primary target X3 for the bearish cat's ears pattern will be down in the 127.5 zone, just below the bright red and big old 2005 to date uptrend, currently at 131.30. A secondary, harder to reach target X4 will be down in the 112.85 zone, around where the dark blue lower trend line is, and that's currently at 113 3/4. And that's for the lower trend line for the 2007-2022 ascending expanding wedge pattern. For the head and shoulders top, we would have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts. And that's the 1975 to date, yes, half a century old uptrend, currently at 65.90. I'm not even going to give you my secondary harder to achieve target for this pattern, as it is below zero. Please bear in mind that these are very longer term targets, stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, this month with changeover we have a spanner in the works for such patterns. The reactionary possible immediate countering monthly key reversal up for July has so far gone back above the purple neckline and stopped for now at the breached early 2016 to date uptrend, currently at 178.20. The question is whether this is just a reactionary single month move higher or the beginning of something else. Now, for now, I will stick to the reactionary single month move higher, but I am prepared now to start looking at the possibility of a new base of support not only being built but also being exploited for a possible move higher. For all this, I need more data as we're dealing with very, very long-term patterns. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.